At Edge, we're building a parametric insurance program for commodity-linked businesses. So off the bat, I can tell you that this is a massive problem, and we've been able to lock LOIs from some of the most marquee food businesses, including FMG Group and McDonald's, Little Caesars, etc. And you may ask why. The reason is we're solving a very, very important problem that directly affects profitability and cash flows. So as you can imagine, price volatility is a massive threat to businesses along the commodity supply chain. This is best explained through an example. So if you take the example of McDonald's, they have massive exposure to a USDA published index called beef trim. Beef trim is a byproduct of a certain part of the live cattle that's ultimately used to make the burger patties. So as you can imagine, if the price of beef trim increases, the input costs into the burger itself increases quite materially. McDonald's budgets start to flip upside down, and they start to see profit margin erosion. And so it's a direct problem that impacts profitability. And so how are we solving this? We're building a parametric insurance protection programs. And the way those work is actually very simple. So let's go through an example. So if you imagine you being a massive food chain like Texas Roadhouse, you have massive exposure to a certain cut of beef, you would log into our platform, select the index that's actually referenced in your physical contract. So it's a perfect one-to-one match. You would then select the type of protection that you want. And so if this is a fixed price spread, you know your business better than anyone else. So you know what price trigger points or margins really start to hurt. So if that price is $9.50, you select the duration. You also know how much you want to protect. We auto-generate a premium. And once you pay us that upfront premium, you get protection at the $9.50 mark. And if that trigger is hit during the life of the contract up to a certain limit, we pay you out automatically. So the product itself is very simple, very easy to understand from a customer perspective. It's a pre-agreed trigger. There's no margin. It's just that one-time fee. There's no claims process and there's no basis risk. On the back end, it's actually very complex to build. So what we're doing is we're ingesting third-party data sources that reference these specific indexes, and we actually build in-house best-in-class forecasts, price a risk from an insurance perspective, and construct a diversified portfolio across untraded commodities. And once we're able to do that, we are actually able to arrive at an appropriate risk price. And there's strong network effects because the more indexes we underwrite, the better diversified our entire portfolio is. In terms of how this works from the back end, so we're going to be a registered MGA. We're going to originate this business across all the target indices in untraded commodities. We're going to sit in the middle. We'll have a take rate of around 20 to 30%, and we pass on the balance sheet risk to reinsurance companies on the back end. For that, our ultimate measure of success is the loss ratio across the portfolio. And the lower the loss ratio, the more profitable the reinsurers are, the higher the cut of the revenue that we get. So the business model itself is quite easy and very simple to understand. And when you think about this opportunity, if you zoom out, look at the realm of untraded commodities globally, agricultural commodities, it's about a $3 trillion market. And so if you apply a conservative 5% premium at scale, this is a $150 billion annual GWP potential opportunity, which could translate at scale to a $35 billion plus opportunity for Edge. And what's more is that we're using this as a wedge to build an end-to-end vertical SaaS platform that companies across the supply chain can use to manage their risk, both before they execute protection and after. In terms of our go-to-market strategy, so we've assembled an inside sales team, founder-led sales, and have seen a lot of success with the larger corporates. There's also many channel partners, such as risk advisory firms, in these nascent untraded markets that could be perfect channel partners for us to distribute our product to mid-sized companies. Our initial target market is animal protein, dairy products, and organic produce. In terms of why we're able to do this in the first place, it's a combination of two things. One, data availability. So the actual untraded indexes that we're referencing in our contracts, those companies that have been reporting that data have only been around for 15, 20 years. And so only now is there a rich enough data set to underwrite and create a diversified portfolio out of. On top of that, we use advanced actuarial mathematics and underwriting techniques to come up with appropriate risk pricing. And if you think about the volatility over the past 5 years, it's been massive, right? And people talk about FX and interest rates, but volatility across commodity markets have been amplified even more. The final thing I'll touch upon is where we are as a company. So we built out our prototypes, have shown indicative pricing. We have a robust pipeline of over 1,000 well-vetted customers. We have our go-to-market channel partners and have also, engaged reinsurers quite meaningfully to secure the capacity. We just closed on our pre-seed round and looking forward to having you all join us in our journey at Edge. Thank you very much.